Hello warriors, Namaste, Namaskaram, Vanakkam, Sasyakal, and welcome to today's session of Crack Costing. We're here to revise the entire costing conceptually in less than 20 hours to help you achieve your dream marks in CA Inter Costing. I'm Tabish Hassan, a chartered accountant, all India ranker, international speaker, your friend, brother and guide, and today we're here to revise the topic standard costing. First, let's have a look at how ICAI is asking questions from this chapter. On an average, we have at least one question of standard costing in every attempt. The average marks per attempt is 8 marks. And in the past 4 attempts, every paper we have a question of 10 marks from standard costing. So undoubtedly, this chapter falls in the category A. Let me ask you one question. Who's Bollywood's or Tollywood's biggest villain? I don't know who that is, but if we ask students who is the biggest villain in costing, 99% students are going to tell it's standard costing. All students fear this chapter the most, 40 plus formulae. Oh my god. But the good thing is all villains get killed. So the fear of standard costing would also get killed. We will together kill that fear. I promise you, standard costing would be the simplest and easiest topic by the end of this session. You need not learn even one formula here. We will develop the logics and prepare the formula ourselves. Your confidence would be to such level that if in exam a question comes from standard costing, you would be jumping with joy and would attempt it as the first question. That's my promise. But I want a promise from you too. Don't sit with the fear of standard costing. Sit with an open mind. I promise it will be the simplest of all topics. One disclaimer. There are some students who've somehow by-hearted all the formulas of standard costing. I've heard students telling 1 minus 2, 2 minus 3, 1 minus 5 and all stuff. It's totally without any logic. And you have a risk of forgetting that in the examination. But if you're comfortable with it, if you're comfortable not knowing the formula and merely by hearting it, go ahead, do not watch this lecture. But if you're not comfortable with it, watch this lecture, but forget all those things that you've learned. Sit with an open mind. But please do not mix both of them. You are simply going to complicate the learning process for yourself. So either go with that approach, by heart the things, get it done, don't listen to the lecture, or sit with an open mind, get ready to learn the logics of every formula. Oof, such a long intro, but it was required. So let's get to the very basics of standard costing. So every chapter, I connect it with my master chart, which I call the world of costing. So costing can be made for existing goods or services or for new goods or services. For existing goods or services, we have two objectives. First is to know what the cost is. Second is to see whether we can reduce the cost or not. To know what the cost is, we call it by the term cost ascertainment. For that, we have different methods of costing. Job costing, batch costing, contract costing, service costing, output costing, process costing. All these are methods of costing. We use them for cost ascertainment, that is to know what the cost is. Now coming to cost control, that is trying to reduce the cost. We have standard costing and budgetary control. So for existing goods or services, we want to do cost control. For that we have standard costing and budgetary control. So what is the difference between standard costing and budgetary control? So standard costing is a difference between standard performance and actual performance. And budgetary control is a difference between budgeted performance and actual performance. Clear? No, right? I'll tell you an example. I thought that I can buy this pen for 1,000 rupees because previously 1 year back I bought this pen for 1,000 rupees. So now I'm thinking that I want this pen again. I can buy this for 1,000 rupees. This is based on historic information. That's the first thing. Now, ideally, if I compare at Amazon, Flipkart and at the local vendor and I place the best buy, I can get this pen right now at 1500. I didn't do any of that. I went to a shop, I bought it, I paid 2000 rupees. So we have 1000 rupees at which I bought 1 year back. And again we have 1500 rupees at which I could have bought had I adopted the best possible measure. And then I have 2000 rupees at which I have brought. This is the budget I thought based on historic information. This is what I actually bought for. This is actual. This is what I could have ideally bought for. This is the standard. So in budgetary control, we see the difference between budgeted performance and actual performance. In standard costing, we see the difference between standard performance and actual performance. Clear? So continuing with the differences. So budgetary control, what is it based on? It is based on past data, right? I thought I could get it for 1000 rupees. What is standard costing based on? It is based on present data. That is the past data adjusted with the recent factors. So based on the recent factors, what is the best price at which I can get this pen for? That is what standard costing tells. So can I assign responsibility under budgetary control? No. Responsibility assignment cannot be made in budgetary control because it is based on factor which is beyond our control. Even if I had adopted the best possible method, I could not have got this pen for 1000 rupees. I used to get it 2 years back. Right now, there is no way to get it for 1000 rupees. So assigning responsibility is not possible in budgetary control. But in standard costing, assigning responsibility is possible. Clear? So now we have understood what is the difference between standard costing and budgetary control. I'll give you another example. Last 30 days are remaining for exams. So I thought I can study for 300 hours. That is 10 hours every day for 30 days. So I thought that I can study for 10 hours every day into 30 days. That is 300 hours. Then in between 5 days, I was not feeling well. So there was no way for me to study for those 5 days. But I could have studied for 25 days into 10 hours each, 250 hours. But in actual, I have studied only for 150 hours. What is budget? What is standard? What is actual? This is budget. This is our original estimation. This is based on historic data. This is actual. What we have actually accomplished. And this is standard. What we ideally could have achieved. That is standard. Clear with this? So for existing goods or services, we want to control the cost. For that, one of the technique we use is standard costing. What we do in standard costing? We compare standard with the actual. So clear with this? So the difference between standard performance and actual performance is called variance. That is by how much actual performance is varying from the standard performance. That's what we're ultimately saying. Clear? So now let's have a look at all the possible variances. We can call it variance, variance. Ultimately, it's the same. Okay. So let's begin with the golden formula for any business. What is it? What every business ultimately wants to earn? Profit, right? And what is profit? Profit is equal to sales minus cost. Clear? So originally I thought I should earn a profit of 200 rupees. For that, I thought that I would sell for 1000 rupees and my cost would be 800 rupees. Clear with this? Now, if my profit has gone down by 20 rupees, that is my actual profit is 180 rupees only. Profit has reduced. What could be the reasons? Option 1 is the selling price would have reduced. Option 2, the selling price is the same, but cost would have increased. Clear? So in standard costing, what are we seeing? What is the reason for fall in profit? We thought we should ideally earn this amount, but actually we have not earned that amount. What is the reason for fall in profit? So if profit has fallen, it can be because of two reasons. One is sales has fallen, or second is cost has gone up. Why has the cost gone up? It can be because of any of the reasons or a combination of more than one reasons. Reason number one, the cost of direct material has gone up. Reason number two, the cost of labor has gone up. Reason number three, the expense amount has gone up. Reason number four, overheads has gone up. Clear? And overheads, I can again bifurcate it between variable overheads and fixed overheads. So either variable overheads could have gone up, or fixed overheads could have gone up, or a combination of all these could have gone up. Clear? So generally businesses won't have direct expenses. So if we eliminate this, the reason for increase in cost could be either direct material has gone up, labor has gone up, variable overhead has gone up, or fixed overhead has gone up. And in Inter, we are only analyzing the reasons why cost has gone up. So we would be learning four variances. We'll be learning four variances. First, we'll learn why material cost has gone up. Second, we'll analyze why labor cost has gone up. Third, we'll analyze why variable overheads has gone up. And fourth, we'll analyze why fixed overhead has gone up. Clear with this till now? So now let's analyze why the cost of material has gone up. This we call by the name material cost variance. So what do we analyze in material cost variance? We are analyzing why the cost of material has gone up from the standard cost. Clear? So what is variance? It is the difference between standard performance and actual performance. So what is material cost variance? Here we see the difference in standard cost of material and actual cost of material. That is, we see what is the change in cost due to change in price of material. Okay. So I'll give you an example. I went to shop. I purchased 10 kg of tomatoes and it was at rupee 10 per kg. So what is the total cost? It comes to 100, right? So how did we get it? Rupee 10 per kg into 10 kgs, right? Rupee 10 per kg into 10 kgs. So what is this? This is the price. What is this? This is the quantity. When we multiply quantity with price, we get the cost. So before getting into material cost variance, first let's know what material cost is. So material cost is equal to quantity into price. Clear with this? So now we have a standard material cost and then we have actual material cost. We have to see why there is a difference between the two. Clear? Let's go further with the help of an example. Okay, so here we have the standard, here we have the actual, and this is the total cost. So standard, we want 100 kgs at the rate 10 per kg. So the standard cost is 1000 rupees, but actual, we've used 120 kgs at the rate of 12 per kg. So actually we have spent 1440 rupees. So what is the difference? 440 rupees. So what has happened here? The actual cost has gone up by 440 rupees. So if the cost has gone up, then what happens to the profit? Cost has increased, then profit would decrease. That means profit has decreased by 440 rupees. Clear? Now we want to learn the reasons why profit has reduced. Why has the profit reduced? Reason number one, we should have used 100 kgs, but we have actually used 120 kgs. That is, we have used more quantity. We should have used 100 kgs, but in actual we have used 120 kgs. That is the first reason. Second reason is, okay, leave quantity. We should have purchased it for 10 rupees, but in actual we have purchased it for 12 rupees. So we have purchased it for a costlier price. That is, price is also increased. So these are the two reasons, and the cumulative effect of it is what our cost has gone up by 440 rupees. Clear? The reasons for increase in cost. The first reason is quantity has increased from 100 to 120 kgs. And the second reason is price has increased from rupees 10 to rupees 12. Okay. Who is responsible to ensure that we are using the right quantity? We are not using more quantity of goods. So production is happening. Who is responsible to ensure that the production is going on using the minimum or the standard quantity? It's the responsibility of production manager. Okay. And who is responsible to ensure that we purchase raw materials at the right price? We have a separate purchase department who place order for the goods. So it is the responsibility of purchase manager. Clear? So our cost has gone up, so our profit has come down. So we are analyzing the reasons. First, we came to know that quantity has increased. Whose responsibility it is? Production manager. Again, price has also increased. Whose responsibility it is? Purchase manager. So now we call both of them. Come here. So they've come to our cabin. So we are telling our cost has gone up by rupees 440. Our cost should have been 1000 rupees, but it is actually 1440. So our cost has gone up by 440 rupees. So when our cost has gone up, our profit has come down by 440 rupees. We ask, who is responsible? Tell me who is responsible. We are going to deduct that amount from your salary. Okay. So here we have with us the production manager, and here we have with us the purchase manager. Okay. So we ask production manager, what mistake have you committed? So he tells, sir, we should have produced the required goods at 100 kgs, but in actual I have used 120 kgs. So I have used more quantity. That is my mistake. So increase in quantity, production manager tells, it's my responsibility. I have added that. So I am ready to bear the consequence for that. Now we ask the purchase manager. He tells, sir, we should have bought the materials at rupees 10, but I bought it for 12 rupees. That is my mistake. So that is my responsibility. It is increase in price, my responsibility. Clear? So now we investigate the purchase manager further. So we ask him, so are you ready to bear the difference in price? We should have got it at 10 rupees, but actually you have purchased it for 12 rupees. So are you ready to bear this cost of 2 rupees per unit? I was like, I don't have an option, so I'm ready to bear it. So the difference in price would be borne by purchase manager, that is rupees 2 per unit. But is it only rupees 2? No, we should get it in terms of a monetary value. This is just price per unit. We have to multiply it by quantity to get the monetary value. So what quantity to multiply it with? Option 1, we can multiply it with the standard quantity of 100 kgs. Or option 2, we can multiply it with the actual quantity of 120 kgs. So if you multiply it with the standard quantity, the total comes to rupees 200. If you're multiplying with the actual quantity, it comes to 240. Okay. Now we ask purchase manager, what is your burden? We have lost 440 rupees. How much is it because of you? We ask the purchase manager. He tells, sir, it's only 200. He tells, sir, take this standard quantity of 100 kgs. We ask why. He tells, we should have manufactured it using 100 kgs. It is because of the mistake of production manager that we have used 120 kgs. So because production manager has made a mistake, because he has used more quantity, we are incurring more cost. So this cost should go to him. We are like, it's fine. Seems logical. But production manager came and production manager had a different view. The production manager tells the entire 240 rupees is due to the default of purchase manager. We ask him why. So production manager tells, see, he is purchase manager. It's like, yeah, he is purchase manager. So his only responsibility is to purchase goods at the right price. Yeah, it is his responsibility. Again, production managers, he should not care how much goods I am using, whether I use 10 kgs, 100 kgs, 1000 kgs, 10,000 kgs, 1 lakh kgs. What is his responsibility? Why we are paying him? Whatever is the quantity, he should buy it at right price. Yes, that's logical too. So, production manager tells, so in case, right now the standard quantity was 100 kgs. If the demand has gone up and we wanted to buy 1000 kgs, can he buy only 100 kgs at 10 rupees and the balance 900 kgs at say 1 lakh rupees? No, right? He has to buy it at the right price. That's his responsibility. So, for the entire quantity he purchases, he should not worry about how I am using, what I am doing with that. What is his responsibility? Whatever he is purchasing, he should buy it at the best price. We are like, this is also true. So, which one is more logical? The second one, right? So, purchase manager is appointed to purchase at the right price. So, whatever he is purchasing in the world, he should buy it at the right price. If there is any difference in the price, we are going to hold the purchase manager responsible. So, this gives us the first formula, that is material price variance, that is the variance in the material cost due to change in the price of raw material. How do we get it as? Difference in price into actual quantity. Purchase manager should not care about what should have been incurred. What is his responsibility? Whatever is the actual purchase he is doing, he should buy it at the right price. Production manager tells, and did he know how much I should have incurred? That is only for me, na. I have never told him we should have used 100 kgs or 200 kgs. What is his responsibility? Don't worry about production. Whatever you are buying, buy at the right cost. That's logical. So, material price variance, it is the responsibility of purchase manager. How do we get it? Difference in price multiplied by actual quantity. Clear? So, in our example, the material price variance is rupees 240. Clear? Now, again coming. Now, we are asking production manager. Okay, till now we are giving full lectures to the purchase manager. Now, tell what you have done. So, production manager tells, sir, I have made a mistake. I should have used only 100 kilos, but I have used 120 kilos. So, for the 20 kgs, I will take the responsibility. Okay. So, for the increase in quantity, production manager is taking the responsibility. What should we multiply it with? We have two options. To get the value, the quantity should be multiplied with price, right? So, either we can multiply it with standard price or the actual price. Which one you should multiply with? Think. It should be multiplied with standard price. Why? Because the difference in price is already borne by the purchase manager. So, we need not account for it again. Okay. Production manager is responsible for using more quantity of raw materials. That is 20 kg of raw material. What is his share of loss? What is his responsibility? Only at standard price. Why? Because beyond that, it was purchase manager's fault. Okay. So, the increase, so the difference in quantity multiplied by standard price. So, the increase in quantity was 20 kgs multiplied by the standard price of 10, rupees 200 would be due to the mistake of production manager. So, this we call the increase in quantity of raw material. We call by the name material usage variance. And how do we get it as? This is change in quantity, therefore difference in quantity, and we multiplied by standard price. Why? Because the change in price is already covered by purchase manager. Okay. Clear with this? So, I'll give you an example from our homes. Okay, generally in most of our homes, okay, mom cooks and dad buys the groceries. Okay, I'm telling the general scenario. Okay, so for simplicity, we'll take mom as the production manager, dad as a purchase manager. Okay, typically in every month, okay, we buy 30 kgs of rice at the rate 30 per kg. Okay, this is the standard. So the monthly cost would come to 900 rupees. But in one particular month, okay, we used 45 kgs and we bought every kg at the rate of 50 rupees. So the cost came to 2250 rupees. So the cost is increased by 1350 rupees. Now mom and dad are both discussing what is going on. So mom is blaming dad, dad is blaming mom. Dad is telling, we should have used only 30 kgs, but we used 45 kgs. What are you doing? Mom is telling, you should have bought it at 30 rupees. You have bought it at 50 rupees. What is this? I should have got another husband. Okay, so this keeps on happening. Okay, so at one point dad tells, what are you doing with the rice? You should have used only 30 kgs, right? What have you done? Why have you used 45 kgs? So mom tells, see, what I do with the rice, don't worry. That's my business. Your friends come, guests come, you have it, our kids have it. You don't ask, you don't question me about that. Okay, why have you bought it at a costlier price? So what was your job? Whatever I ask you to buy it at the right price. This month I ask you to buy 30 kgs, you buy 30 kgs at the right price. Next month I ask you to buy 50 kgs, buy 50 kgs at the right price. The next month I ask you to buy 100 kgs, buy 100 kgs at the right price. This is one work I had given you. Can you not even do that properly? Yes. So what happened? So for the actual quantity, whatever is the difference in price would be incurred by the purchase manager. In our example, it was that. And for the increase in quantity multiplied by standard price, whatever is the burden would be incurred by the production manager. That is mom in our example. So this is 15 kgs extra at the rate standard price 30 rupees gives us 450. And for the purchase manager, the difference in price, that is 20 rupees for the actual quantity 45 kgs gives us 900 rupees. This is how we get our total variance. Clear? Okay, once again let's discuss. Our profit has reduced and we are analyzing the reasons why our profit has reduced. So we got to know that one of the reason is because our material price has increased. So how do we get the material cost? Material cost is equal to quantity into price. Clear with this? So we got the material cost variance. What is the material cost variance? Standard cost minus actual cost. Standard cost minus actual cost. What is standard cost? Standard quantity into standard price minus actual quantity into actual price. Now we are looking into the reasons why this happened, why the profit has fallen, why the profit fell down. We came to know there are two reasons. One is due to increase or decrease in quantity. Second is due to increase or decrease in price. For the increase or decrease in price, who is responsible? Purchase manager is responsible. What do we call this as? We call it as the material price variance. Okay, how do we get it? It is the change in price. So difference in price into actual quantity. Why actual quantity? Because purchase manager is responsible for the entire quantity. So we multiplied with the actual quantity. And for increase or decrease in quantity, who is responsible? The production manager is responsible. What do we call it as? We call it as the material usage variance. How do we get it? It is an increase or decrease in quantity. So we take the difference in quantity and we multiply it with standard price. Why standard price? Because the responsibility for change in price is of purchase manager and it is already incurred. Clear? Now, so how do we get difference in quantity? It is standard quantity minus actual quantity into standard price. Difference in price is standard price minus actual price into actual quantity. Okay, let's expand this. So here we have SQSP minus AQSP plus we have SPAQ minus we have APAQ. Okay, this and this is the same, it gets cancelled, and ultimately we have standard quantity into standard price minus actual quantity into actual price. That is a clear. In our example, the material cost variance was 440 rupees. Okay, in that, due to increase in quantity, we had 200 rupees. Due to increase in price, we had 240 rupees. That's how when we added both, we got our 440 rupees. Clear till now? So let's revise it through another way. I call it the magic box revision. First, we have the standard cost of raw material, that is standard quantity into standard price. Then we have the actual cost of raw material, that is actual quantity into actual price. The difference between standard cost and actual cost is the material cost variance. Clear? Now we are analyzing the reasons. So we have two reasons. One is quantity could have changed or the price could have changed. First, let's eliminate price from this. Okay, we are eliminating price impact. Okay, so what do we get? So price variance is a difference in price. That is, here we have actual price. So here we want standard price and the difference in price for the entire actual quantity. So again, I multiply it with the actual quantity. Okay, so if I analyze it this way, here the price has changed and this is for the entire actual quantity. This is the material price variance, and who is responsible? Purchase manager. Here if we see, the quantity has changed and we turn it into value by multiplying it with standard price. So this is the material usage variance, and who is responsible for this? Production manager is responsible for this. Clear with this? Clear till now? So we have discussed material cost variance, material price variance, material usage variance. Now let's go further. Okay, I've got an example here. Suppose we manufacture Coca-Cola. Okay, so to manufacture Coca-Cola, we want the Coke syrup and we want water. Okay, so the standard is to use 5 liters of Coke syrup at the rate 25. Okay, and 10 liter of water at the rate 10 rupees. So the standard cost is 225 rupees. In actual, what we have done is we've changed the ratio. Okay, we've used 10 liter of Coke syrup at the rate 25. We've used 5 liter of water at the rate 10. Okay, people will anyways not know. People will anyways drink Coca-Cola. So we've changed the proportion. Okay, and our actual cost has come to 300 rupees. There is a difference in cost of 75 rupees. Our cost has gone up by 75 rupees. So our profit has come down by 75 rupees. Now we are seeing who is responsible. Okay, purchase manager tells, boss, standard price was 25 rupees. Actually also I have purchased it 25. Again for water, the standard price was 10 rupees. Actually also I have purchased it at 10 rupees. So please don't even look at me. I am not into it. Clear? Because the standard price and actual price is same throughout. So we cannot hold the purchase manager responsible. Now we came to the production manager. Production manager is telling, see, totally I should have used 15 liters. Actually also I have used 15 liters. So I am also not responsible. You asked me to use 15 liters. I have actually also used 15 liters. So where is the difference? That too sounds logical. So where the difference has occurred, he should have actually mixed 15 liters in the ratio of 5:10, that is 1:2, but actually he has mixed it in the ratio of 10:5, that is 2:1. So mainly the difference occurred in the mix. Okay, that is again production manager's responsibility. He should have ensured that he is mixing things in the right quantity. Okay, so two things we have learned. Firstly, okay, don't go by the total approach. Don't look at total quantity, total price, total cost. Go individually, component wise. That's the first rule. Second, if we have more than one component and the price is the same, the change in cost could be due to change in mix, or it can also be because we have used more quantity. So two reasons. One is there is a change in mix, or the second is quantity only actually we've used. That is, instead of 15, I've used 16 liters. That is also possible, right? So those are the two reasons. We allocate the increase in cost of 75 rupees between the change in mix and the change in quantity. How do we do that? Okay, so we should bring a new element called as revise the standard quantity. So we have standard quantity, we have actual quantity. What is this revised standard quantity? Here we bring actual quantity in the standard mix. I'll explain. So we have standard quantity, here we have actual quantity. What is standard quantity? It is the standard quantity in standard mix. What is actual quantity? It is the actual quantity in actual mix. In our example, standard quantity was 15 liters in the ratio of 1:2. Here it is, say for example, I'll change the example for simplicity. I'll assume the actual quantity is 20. So 20 liters in the ratio 2:1. Okay. So what is revised standard quantity? It is actual quantity in standard mix. So actual quantity of 20 in the standard mix of 1:2. This gives us revised standard quantity. Okay. So let's see how it helps. So what do we want to see? We want to see how much cost extra we've incurred only due to change in mix. That's the first thing. Second thing is how much cost extra we've incurred only due to change in quantity. Those are the two bifurcations we need. Okay. So let's compare standard quantity and revised standard quantity. Okay. So standard quantity is standard quantity in standard mix. Revised standard quantity is actual quantity in standard mix. What happened here? Here the mix is same. In both the places we are mixing the materials in the ratio of 1:2. But what is the difference? The difference is in the quantity. Okay. So we call this by the name material sub-usage variance. It is an extension of usage variance. Okay. We come here. So we analyze it here. Okay. This is actual quantity in actual mix. This is actual quantity in standard mix. So quantity is the same, but the difference is only in the mix. In the proportion things are mixed. In revised standard quantity it was mixed in the ratio 1:2, but in actual quantity it is mixed in the ratio 2:1. So here quantity is same, only mix is different. So we call it the material mix variance. Okay. How do we get the formula? In the sub-usage variance, what are we comparing? We are comparing standard quantity with the revised standard quantity. So we see the difference in standard quantity with the revised standard quantity. And here what are we seeing? We are comparing revised standard quantity with actual quantity. So we see the difference in a revised standard quantity with actual quantity. And what is it multiplied with? So to get the value, the quantity should be multiplied by price, right? So which price? Standard price or actual price? We've already discussed the difference in price is already covered in the material price variance. It is a responsibility of purchase manager. So later on it will not come. So everywhere we are multiplying it with standard price. Okay. So now let's see further. Okay. Mix is different. Who is responsible for this? Okay. Who is responsible to ensure that the materials are mixed in the right proportion? It is a responsibility of production manager. Okay. So material mix variance, it is because of production manager. And production is going on. They should have used only 15 kilos, but in actual they've used 20 kilos. Whose mistake is this? This is the mistake of the workers who are working there. It is production manager's job to supervise, but who is at fault? Finally, if you want to assign one person who is at fault, who is at fault here? This is the final employee is at fault here. Clear? So now let's see an example here. Okay, so we have the standard price, we have two inputs. Okay, we have the standard quantity, we have the actual quantity. Now let's get the revised standard quantity. Okay, so what is revised standard quantity? It is actual quantity in the standard mix. That is actual quantity 21 in the standard mix. What is standard mix? 10:5. That is 2:1. So how do I get it? 14 and 7. So it gives me 21. Clear? So now how do I get? So everywhere the multiplier is the standard price only. So first I have the material mix variance, then I have the material sub-usage variance. In both places the multiplier is standard price. But what am I looking at here? I want to see the change in mix. Okay, so just the mix has changed. So what do I compare it with? I compare revised standard quantity with actual quantity. Why? Revised standard quantity is actual quantity in standard mix, actual quantity is actual quantity in actual mix. So here the mix is different. So that's why this is the formula, and I do it individually, get the total. And in sub usage variance, what am I saying finally? How much ultimately quantity have increased. So here the ratio, the mixing is same. So what do I use? I use standard quantity minus revised standard quantity. Why? Standard quantity is standard quantity in standard mix, revised standard quantity is actual quantity in standard mix. So the mix is same, the only difference is in the quantity. Clear? Now let's come to a very interesting part, that is blast from past. Here we discuss what mistakes students generally do in the exams and how do we avoid them. Okay, so first is recognizing favorable or adverse variance. Okay, so if we write in exam that variance is equal to 200, is it right? No, it is totally wrong. We should write what is 200. Is it 200 favorable or 200 adverse? 200 favorable means our profit has increased by 200 from the standard profit. We thought we could earn 1000 rupees, but in actual we have earned 1200 rupees. So our actual profit has increased. That is favorable for us. But if our actual profit has decreased, this is adverse for us. Okay, so this is if actual profit has increased. Okay, this is if actual profit has decreased. We are now analyzing only the cost. So if actual profit has increased, what should have happened to the cost? Actual cost should have decreased. And if actual profit has reduced, what should have happened to the cost? Actual cost should have increased. Clear? Now let's design a formula in such a way that whenever we get positive number, it denotes favorable, because our mind is adopted to that. Okay, so favorable is equal to standard cost minus actual cost. Is this right? Okay, the standard cost was 1000 rupees, but my actual cost is only 800 rupees. Is it favorable? Yes, it is favorable. So we always write it as standard cost minus actual cost. If it is positive, we write it favorable. If it is negative, we write it adverse. Clear? So for material cost variance, how do we write it? We write it standard cost minus actual cost. For material price variance, what do we write? The difference in price. So even when we are writing difference in price, we write standard price minus actual price multiplied by actual quantity. Material usage variance, difference in quantity, it is standard quantity minus actual quantity into standard price. Again, material mix. Okay, so the multiplier is standard price, and we do revised standard quantity minus actual quantity. Why do we do this? Because this is actual quantity in standard mix, this is actual quantity in actual mix. We are looking at the change in mix. So first we'll write the standard mix, then we'll write the actual mix. Clear? And then again for the sub usage variance, it is standard price into standard quantity minus revised standard quantity. Why? What are we seeing? The increase or decrease in quantity. What is this? This is the standard quantity. And what is this? This is the actual quantity. Clear? Even going ahead for labor variances, for variable overhead variances, for fixed overhead variances, everywhere remember this, it is always standard cost minus actual cost. So if standard cost minus actual cost is favorable, if standard cost minus actual cost is positive, that means the variance is favorable. Standard cost minus actual cost is negative, that means the variance. If standard cost minus actual cost is negative, that means the variance is unfavorable or adverse. Clear? That's the first point. Second thing, we need to calculate the standard cost for actual output. Okay, suppose the standard is for one output, the cost is 100 rupees. In actual, we have manufactured 4 output and our cost is 390 rupees. Are we producing at a cheaper price or are we producing at a costlier price? How do we compare? Okay, if we just look based on the price, we are producing it at a higher price because we are paying 290 rupees more. But if we see here, there is a difference in quantity also. Okay, so when we have a difference in the actual output, so if we just see on the outer surface, we think that we have actually incurred 290 rupees more. But if we see in terms of the output, for 100 rupees we are manufacturing only one output, but in actual we have manufactured 4 units of output. So 1 unit of output and 4 units of output, the cost cannot be compared, right? We have to bring it to a common base. Okay, so actually we have produced 4 units of output. So we see, if we were producing 4 units, okay, so what is the standard cost? What is the standard cost for actual output? So for 4 units, if it is 100 for 1 unit, it could have been 400 rupees. But I've actually manufactured it at 390 rupees. That means I've manufactured it at 10 rupees less. So 10 rupees is the favorable. Okay. The thing to be said here is, whenever we are telling standard, standard is always for actual output. Okay. So if I'm telling standard cost, that means standard cost for actual output. If I'm telling standard quantity, that is also standard quantity for actual output. Standard price is anyways on per unit basis, so there is no difference, right? Clear? Even for labor variances, overhead variances, everywhere we are using the term standard. It means standard for actual output. Make it very clear in the mind. Standard is standard for actual output, because we have to compare it on a same playing field. That's why we bring everything to the actual output basis, and on that we compare. Clear? That's the second point. Third point, in exams, okay, ICAI gives a concept called as budget, standard and actual. What is it? So in reality, budget means budgeted performance versus actual performance. But what ICAI does is, ICAI uses the word budget and standard interchangeably. Okay. So for the exams, what they do is, say for example, they give budget and actual. So what does budget mean? Budget is also a standard. So from the exam perspective, okay, whenever they use the term budget in a standard costing question, what it infers is, budget means standard cost for budgeted output. Okay, the actual cost is actual cost for actual output. Okay, the budgeted output and actual output cannot be compared. So what we have to do is, we have to always bring the standard cost for actual output. This is called by the term standard in the exams. So this is standard cost for actual output. Say for example, okay, here is the quantity, here is the price, so this is the cost. Okay, budgeted for 10 units. For 10 units of output, the quantity to be used is 20 kilos and the price is 10 rupee per kilo. So the budgeted cost for 10 unit was 200 rupees. In actual, we have manufactured 100 units. Okay, so we have used 220 kgs at the rate 11 per kg. So our actual cost is 2420 rupees. This 200 cannot be compared with 2420 because there is a change in units. Here it was 10 units, here this is 100 units. So what we have to do is, we have to convert this to 100 units. That is, standard cost for 100 units is, so for 10 units it was 20 kgs, so for 100 units it would be 200 kgs, and the price was 10 per kg, so it would be again 10 per kg. So the standard cost is 2000. So this difference is the variance, that is 420 adverse. Clear? Next, if in exam there is a different data for purchase, the data is different for consumption, which one should we opt? We should always take consumption. Why? See, if we have purchased and we have not consumed it, it will be in our closing stock. So it falls in the debit side in the purchase, again in the credit side in the closing stock, it gets netted off. So for the period there is no cost. And what are we finally seeing? We are finally seeing how much cost has increased. So only if we consume in our P&L we put it as a cost, and only for the cost we are seeing whether the cost has increased or decreased. So if it is not a cost only for this period, if it is just transferred to the next period, so there is no point in analyzing the variance, right? So whenever we are telling standard quantity and actual quantity is the actual quantity we have consumed in the period. How do we get the quantity consumed? We have the trading P&L, we have the opening stock, we have the purchase, we have the consumption, we have the closing stock. So opening stock plus purchase is equal to consumption plus closing stock. So consumption is equal to opening stock plus purchase minus closing stock. Clear? So if in the question we have data about opening stock, purchase or closing stock, know that we have to take the consumption for the period, because ultimately only the consumption is our cost. Clear? Next, some important things to be remembered for exams. First, for every variance, write the formula. Say material cost variance is equal to standard cost minus actual cost is equal to standard quantity into standard price minus actual quantity into actual price. Write the formula at the beginning for every variance. It carries marks. Next thing, do individually every variance. Do every variance individually for every material and then do a total. Say we have two materials, X and Y. So first do the variance for material X, then do it for material Y, then at the end write the total. That's how we are supposed to do it. Next, always write favorable or adverse. Okay, there are so many papers where the standard costing question of 10 marks, everything is right, every number is right, but they have not put favorable or adverse, and they would only get 2 or 3 marks in 10 marks. Okay, writing favorable or adverse is that important, so never forget it. Next, at the end of every question, draw a chart telling material cost variance is equal to 440 adverse. So in this, the material price variance is equal to 200 adverse. For example, material usage variance is equal to 240 adverse. Again, what is a sub usage variance and mix variance? So what it does is, firstly, at the end, when we have a chart like this, okay, it becomes very easy for the examiner. He can just come in here, look at if the answers are correct or not, just glance through the answers and give you full marks. Okay, that way it helps. Secondly, it is a way of good presentation. Thirdly, what it helps is, it helps us to cross check. Okay, so we have 440 adverse here. So we have 200 plus 240. So if we add both, we get 440. So this is matched here. Again, we have, say for example, we got 200 adverse and say 140 adverse. So now here we know it is not right because we are not getting 240 adverse. So we can go back again, change it, and oh, we realize it was only 40 adverse. So it helps us for cross verification also. So every time at the end of the question, just draw a chart. It only takes 1 minute. Clear with this? So with this, we have ended discussion of material. So with this, we've ended discussion of material cost variance. Let's quickly revise it all over again. Okay, so material cost variance, what are we seeing? We are seeing the fall in profit due to increase in the cost of material. And what is the material cost? It is quantity into price. Okay, so material cost variance is standard cost minus actual cost. Standard cost is standard quantity into standard price minus actual cost is actual quantity into actual price. So what are the two reasons why cost has gone up? One, either the quantity would have changed. Second, or the price would have changed. Let's analyze price. Okay, so the change in price, who is responsible for this? Purchase manager is responsible for this. So what he has to bear? He has to bear the difference in price. Okay, so the difference in price has to be multiplied with quantity. What quantity we will take? We will take actual quantity. Why we are taking actual quantity? Because for the entire quantity, he had to buy it at the right price. So he is responsible. So what is material price variance? It's the difference in price into actual quantity. Coming to production manager. Okay, the quantity has increased or decreased. So he'll have to bear the loss due to increase in quantity. So he'll bear difference in quantity into standard price. Why standard price? Because the impact of price is already borne by purchase manager. So this is called material usage variance, that is difference in quantity into standard price. Now if we have more than one input, we will analyze the usage variance further. Okay, so what could be the two reasons? One is the actual quantity has increased or decreased. Second is mix has changed. Okay, so the actual quantity has increased or decreased. We call it by the term sub-usage variance. Who's responsible? Actual employees are responsible. How do we get it? Always the multiplier is standard price into standard quantity minus revised standard quantity. So what are we looking here? Standard quantity is standard quantity in standard mix. Revised standard quantity is actual quantity in standard mix. So the mix is same, the only difference is in quantity. Yes. Next, coming to mix. Okay, so it's called mix variance. Who's responsible? The production manager is responsible. How do we get it? Standard price is the multiplier into revised standard quantity minus actual quantity. Okay, how do we get it? Revised standard quantity, it's actual quantity in standard mix, and actual quantity is actual quantity in actual mix. So quantity is the same, the only difference is in the mix. Okay, so this was a super fast revision of material cost variance. Let's revise it from one more technique. Okay, so this is a magic box technique. Okay, so first we have the standard cost, that is standard quantity into standard price. Next we have the actual cost, that is actual quantity to actual price. The difference between standard cost and actual cost is a material cost variance. Okay, so we got the material cost variance. Now what we are going to do is, first we'll eliminate the price. Okay, so here is the actual price, so here we will put standard price, and price variance is for the entire actual quantity, so the multiplier we put it as actual quantity. So now we compare it here. So this is actual price, this is standard price. So this is a difference in price. So it's called price variance. Now we compare this one with this one. So here we have standard quantity, here we have actual quantity, and the multiplier is standard price. So this is usage variance. So done with the first level of analysis. Now we'll go further to analyze the usage variance. Always the multiplier is standard price. Okay, so comparison of standard quantity with actual quantity gives us usage variance, that we have already discussed. Now we bring in a new element called as revised standard quantity. What is revised standard quantity? Actual quantity in the standard mix. So let's compare standard quantity, revised standard quantity, and actual quantity. So what is standard quantity? It is standard quantity in standard mix. What is revised standard quantity? Actual quantity in standard mix. What is actual quantity? Actual quantity in actual mix. Okay, let's compare standard quantity with revised standard quantity. Here the mix is the same, it is a standard mix, but the difference is in the quantity. Here we have standard quantity, here we have actual quantity. So it is a difference in quantity. So we call it the sub-usage variance. Now we compare revised standard quantity with actual quantity. Here also we have actual quantity, here also we have actual quantity. But here it was in standard mix, here it is in actual mix. So the difference is in mix. So we call it the material mix variance. So we've revised the material cost variance in every possible scenario in the limited time. Now take a break. Go solve questions on material cost variance right now and then come back to labor cost variance. Clear? So we discussed material cost variance. In material cost variance, we had the material price variance, material usage variance. In material usage variance, we again had the material sub-usage variance, and also we had the material mix variance. Clear? Now let's proceed to the labor cost variance. Okay. So labor cost variance can be bifurcated into two parts. Labor cost variance, one is without idle time, second is with idle time. Okay, so first let's discuss the labor cost variances without idle time. Clear? So what are we seeing in labor cost variance? We are seeing how much my profit has reduced due to an increase in labor cost. And what is labor cost? It is labor hours into labor rate per hour. Suppose an employee is working under me. He is worked for 8 hours and I am paying him at the rate of 100 per hour. What is my total cost? It is 800 rupees. How did I get it? Labor hours into labor rate per hour. Clear? So if we know material cost variance, labor cost variance is the simplest. There's nothing to worry at all about the labor cost variance. Okay, so let's directly start developing the formula. Labor cost variance is the difference between standard cost and actual cost. And what is standard cost? It is standard rate into standard hours minus actual rate into actual hours. Clear? So he should have worked for 8 hours at the rate of 100 rupees per hour. That is 800 rupees is the standard cost. He's actually worked for 10 hours at the rate of 120 per hour. 1200 is the actual cost. The 400 difference is the variance. That is the increase in cost. Okay. So this can be again due to two reasons. So which is visible here. First is the rate has changed or the hours have changed. First thing, the rate has either increased or decreased, or second, the hours have either increased or decreased. Clear? So if the rate has increased or decreased, who is responsible? In every organization, there is something called as the personnel department or the HR department. They are responsible to ensure that they get the employees at the right price. So if the rate has increased or decreased, it is the responsibility of personnel or HR department. If the hours have increased or decreased, who is responsible? It is the responsibility of production manager. Clear till now? Now, how much responsibility do we assign? So we assign him the responsibility for, so it is difference in rate into standard hour or actual hour. It is actual hour. Why? Because irrespective of the hours he has worked, it is the responsibility of HR department to get him at the right price. So it should not worry about the standard hours, actual hours. For the actual hours, whatever is the change in rate, it is the responsibility of personnel department. Clear? So what do we call this variance as? We call it as the labor rate variance. Clear? So for the difference in rate, we've held the personnel department responsible. So it is difference in rate into actual hours. Now coming to the difference in hours. So production manager is responsible. It is for difference in hours into standard rate or actual rate. It is standard rate. Why? Because the difference in rate is already being covered by the personnel department. Clear? What do we call this? So an employee should have taken 8 hours. He has in actual taken 10 hours. What do we call him? The employee is not very efficient. He is taking more time. Other example, the employee should have taken 8 hours. He is taking only 7 hours. We call the employee is efficient. So the difference in hours, what does it denote? It denotes the efficiency of employee. So you call it by the name efficiency variance. Clear? Labor cost variance is standard cost minus actual cost. Two reasons. First is when the hours have increased or decreased. Second is when the rate has increased or decreased. For the change in rate into actual hours, it is called labor rate variance. For the change in hours into standard rate, it is called the labor efficiency variance. Clear till now? Now let's debug efficiency variance further. Okay, assume there are more than one class of employees. Suppose we have the semi-skilled employees, the skilled employees, and the unskilled employees. So there can be a chance that the mix has changed, right? So how do we analyze it further? Okay, so we have the standard hours, we have the actual hours, then what do we bring? We bring the revised standard hours. It's exactly same as material cost variance. What is standard hours? It is standard hours in standard mix. What is actual hours? It is actual hours in actual mix. What is revised standard hours? It is actual hours in standard mix. It is actual hours in standard mix. Okay. So when we compare the both, when we compare standard hours with actual hours, what we get is efficiency. Now we are comparing standard hours with revised standard hours. Okay, the mix is the same. The only difference is in the hours. So what do we call? We call it as sub-efficiency variance. And who is responsible for this? It is because workers have spent more time. The workers are responsible for this. Here, the hours spent is the same. The only difference is in the mix. Okay, so what do we call it? We call it the labor mix variance, or there is one more name for this. We call it the labor gang variance. Who is responsible for this? The production manager is responsible for this. Clear? To be very simple and very precise, if we know the material cost variances, it is very simple to get the labor cost variances. Okay, let's develop a comparison from material cost variances to labor cost variances. Okay, First, let's see where the name changes. Okay, so in material, the material cost variance we called material cost variance. Here it's labor cost variance. Clear? Next, we had the material price variance. Here we call the labor rate variance. Then we had the material usage variance. Here we are calling it the labor efficiency variance. Okay, so usage variance we split it further. So efficiency variance also we are splitting it further. Usage variance we called one as the sub usage variance. So here we are calling it the sub efficiency variance. Again, one more we had the usage the sub usage variance and the mix variance. Here again we are calling it mix or gang variance. Clear? That's the first kind of comparison. Second, in material we had quantity into price. In labor we have hours into rate. So everywhere we have quantity, if we replace it with hours, and everywhere we have price, we replace it with rate. It's automatically prepared. Clear? So we've discussed the labor cost variances without idle time. Now let's come to the labor cost variances with idle time. The labor cost variances with idle time. Okay, so before coming into this, let's first know what idle time is. Idle time is the time when the labor is getting payment but he is not actually working. Okay, so idle time can be further bifurcated into normal idle time and abnormal idle time. Normal idle time, generally the worker goes for lunch, he has a tea break. All this is normal idle time. It is unavoidable. Abnormal idle time, say for example, power breakdown. Say for example, the power cut or machine breakdown. All these are avoidable. They could have avoided it if they had taken precautions. So this is called as abnormal idle time. What happens to normal idle time? It is already adjusted while we are setting the standards. Okay, so while we are setting the standards, say for example, okay, the actual standard time to manufacture 1 unit of this is 10 minutes. Okay, but there is normal idle time throughout the day. So what we do is we adjust this and then we tell the standard time taken, that is the standard hours taken for this is 12 minutes. So 2 minutes of normal idle time is already adjusted. So there is no need to consider it again. But for abnormal idle time, what we have to do is we have to treat it separately. Okay, so what is abnormal idle time? It's a difference between actual hours we are working and the actual hours for which we are getting payment. Okay, in a day we are getting payment for 9 hours. Okay, but we are actually working only for 7 hours. Okay, the difference in the 2 hours is called the abnormal idle time. Okay, so it will always be adverse. Okay, it will always be adverse. Idle time will never be favorable. Okay, so idle time in its nature itself is adverse because we are paying for 9 hours, he is working for 7 hours. That's when we call the difference of 2 hours as idle time. So idle time by its nature is always adverse. Okay, so how do we get the idle time variance? Okay, it is always the difference between actual hours paid and actual hours worked. Okay, so we have the work, we have to multiply it with the rate. Which rate do we take? We always take the standard rate. Why? Because the difference in rate is already covered by labor rate variance, so we multiply it with the standard rate. Clear with this? Okay, we've just discussed the idle time variance. Now let's develop the entire labor cost variance once more, now having the idle time flavor in this. Okay, so the labor cost variance, again it's the standard cost minus actual cost. What is a standard cost? Standard rate into standard hours minus actual rate into actual hours. Is it actual hours paid or actual hours worked? Is actual hours paid, because that is our ultimate cost. Okay, say for example the rate is 100 and the hours worked is 8, so it comes to 800, and hours paid is 9, so it's 900. So what is the ultimate cost to the company? In labor cost variance, what are we seeing? What is the ultimate cost to the company? So here we see the actual hours paid. Okay, clear with this? So this is labor cost variance. Labor cost variance can be bifurcated into 3 different variances. First is due to difference in rate. It's called the labor rate variance. And next is due to the idle time flavor. and next is due to the efficiency. Okay, so how do we get the labor rate variance? It is a difference in rate into actual hours worked or actual hours paid. It is again actual hours paid. Okay, firstly, when we are getting the rate variance, it is difference in rate into actual hours. Okay, so it should be actual hours paid. Why? Because it does not matter, okay, whether he is working or not. What was the responsibility of HR department? To get the employee at the right price. They have failed in that. So for the entire hours we are paying him, the responsibility of difference in rate goes to the HR department. So it is actual hours paid here. Clear with this? So difference in rate is already covered here. So from now on, whatever we are taking, we would only be multiplying it with the standard rate. Okay, so what is idle time? It is the difference between actual hours paid and actual hours worked. Okay, so we got the difference in hours. How do we convert it into monetary value? We multiply it with the rate. And what is the rate we are multiplying it with? We are multiplying it with standard rate. Why standard rate? Because the difference in rate is already covered in the labor rate variance. Clear? So now we have the efficiency variance. Okay, so efficiency variance is a difference between standard hours and actual hours worked. This is the key here, and again the multiplier is standard rate because the difference in rate is already covered by labor rate variance. But the question is, why are we taking actual hours worked here? What is the objective? What are we seeing? We are seeing the efficiency of the employees. We are seeing if the employee is efficient or not. Okay, I'll give you an example. Standard hours is 100. Okay, actual hours paid is 120, but actual hours worked is 95. Is the employee efficient or not? If we compare 100 with 120, we will tell the employee is not efficient. But is it his mistake that he has taken 120 hours? No. It was due to management's failure that he is not working for 25 hours. He could have finished the work in 95 hours. He has finished the work in 95 hours. So if we see, 100 hours is the standard time. He has done it in less time. So he is more efficient. Okay. So whenever we are calculating efficiency, we compare standard hours with the actual hours worked. Clear with this? So we got the first level of analysis. Main thing to note here is, in the labor cost variance, we are taking actual hours paid. In the labor rate variance, we are taking actual hours paid. In the idle time variance, we are taking the difference between the actual hours paid and actual hours worked. And efficiency variance and onwards will only be taking actual hours worked. Okay. Now let's dig efficiency variance further. So we have standard hours, we have actual hours worked. Now we'll bring the revised standard hours. Clear? What is standard hours? It is standard hours in standard mix. Revised standard hours is actual hours in standard mix. Actual hours worked is actual hours in actual mix. Okay, here if we see what is the difference, mix is the same. The difference is only in hours. The difference is in hours. So we call it the labor sub-efficiency variance. Okay, here if we see, the hours is same, the difference is only in mix. The difference is in mix. So we call it the labor mix or gang variance. Clear? So with this, we are done with labor cost variance. Okay. So I've already given you the checklist for labor cost variance, that is from material cost variance to labor cost variance. If we have to convert, what are all the points we need to keep in mind? Now for idle time variance, when idle time is included, what is the additional point to be remembered? Okay, in very simple terms. Okay, so labor cost variance and labor rate variance, that is the first two variance, labor cost, labor rate. We do it on actual hours paid. Okay, next idle time variance, we do it on the difference between actual hours paid and actual hours worked. Okay, and next efficiency, sub efficiency and gang or mix variance, we do it based on actual hours worked. Clear with this? So we are done with material cost variance. labor cost variance. We are left with variable overhead cost variance, fixed overhead cost variance. Okay. For now, this is sufficient. Go home, try solving all the questions, revise the formulas again. Tomorrow we'll meet again. We will debug variable overhead cost variance and fixed overhead cost variance in the same way. Okay. So material cost variance and labor cost variance, we've already revised it 2 times. First, while I was explaining, then at the end of the concept. But it's not done. We have one final level of, but it's not done. We have one final round of revision, the rapid revision of material cost variance and labor cost variance. Are you ready? Okay. So material cost variance, what are we seeing? We are seeing how much profit has fallen due to increase in cost of material. And what is the cost of material? It is the quantity of material into price of material. Clear? So what is material cost? It is the standard cost minus actual cost. Standard cost is standard quantity into standard price minus actual cost is actual quantity into actual price. So if the material cost has increased, there can be 2 reasons. One is the quantity has increased or decreased, and the second is price has increased or decreased. Okay. So if the price has changed, okay, who is responsible for it? The purchase manager is responsible for it. So how much he is responsible for it? He is responsible by, so how do we see? So material cost variance is a difference between standard cost of material and actual cost of material. So standard cost of material is standard quantity into standard price. Actual cost is actual quantity to actual price. If the material cost has varied, it can be because of 2 reasons. One is the quantity has varied or the price has varied. Okay. So if the price has varied, we call it the price variance. If the quantity has varied, we call it the usage variance. Okay. For change in price, who is responsible? Purchase manager is responsible. How do we get it? What has changed? Price has changed. So we get the variance as difference in price into actual quantity. Why actual quantity? Because for the entire quantity, the purchase manager was responsible to get it at the right price. So that is material price variance. That is difference in price into actual quantity. Now coming to the difference in quantity. It is called usage variance. Who is responsible? Production manager is responsible. How do we get it? It is a difference in quantity. So difference in quantity into standard price. Why standard price? Because the difference in price is already covered by the material price variance. So we got the material cost variance, material price variance, and material usage variance. Now, if you have more than one input, okay. Now, if we have more than one input, okay, so we have the standard quantity, we have the actual quantity, we have the revised standard quantity. Okay, so the variance could be one of the 2 reasons. One is actual quantity has increased or decreased. Second is due to the mix, the proportion in which quantities are mixed. Okay, so the mix is denoted by material mix variance. Who is responsible for this? Production manager is responsible for this. How do we get it? Always the multiplier is standard price, and we multiply and we compare. Always the multiplier is standard price, and we compare revised standard quantity with the actual quantity. What is revised standard quantity? Actual quantity in the standard mix. What is actual quantity? Actual quantity in the actual mix. So quantity is the same, only mixing is different. Now coming here, okay, when the actual quantity has become more or less, what do we call it? The sub-usage variance. Who's responsible? The actual employees are responsible. How do we get it? The multiplier is standard price, and we are comparing standard quantity with revised standard quantity. What is standard quantity? Standard quantity in standard mix. What is revised standard quantity? Actual quantity in standard mix. So the mix is same, it is a standard mix, but only quantity has varied. Okay, so it is called sub-usage variance. Let's revise it in another format, the magic box. So we have the standard cost, we have the actual cost. Standard cost is standard quantity into standard price. Actual cost is actual quantity into actual price. From actual cost, we are eliminating the price variance. So here we have the actual price. So here we will be having the standard price. Okay, and the multiplier is actual quantity, because price we take it on the entire actual quantity. Okay, so first when we eliminated the price, so we got the price variance, and the first and the second box we get the material usage variance. Clear? Now let's sub-analyze it. So now let's analyze the material usage variance further. Okay, first rule is multiplier is always standard price. Okay, and what are we comparing? We have the standard quantity, we have the actual quantity. Okay, so we get the revised standard quantity. What is revised standard quantity? Actual quantity in standard mix. So now let's compare standard quantity with revised standard quantity. Okay, so here if you see, the mix is the same, but only quantity has changed. So we call it the sub-usage variance. Now we'll compare revised standard quantity with actual quantity. What has happened here? The actual quantity is the same, but mix has changed. Okay, so we call it the mix variance. So we've discussed, so we've revised material cost variance once again. Now let's revise labor cost variance one final time. Okay, I'll be revising labor cost variance with idle time. Without idle time would be anyways similar to material cost variance. So what is labor cost variance? We are seeing by how much the profit has increased or decreased due to change in the labor cost. What is labor cost? It is hours into rate per hour. So the labor cost variance is standard cost minus actual cost. The standard cost is standard rate into standard hours, and the actual cost is actual rate into actual hours paid. Okay, it can be further bifurcated into three variances. First is the labor rate variance, then is the idle time variance, then is the efficiency variance. In labor rate variance, we identify how much of variance is due to change in the rate of employees. Okay, so it is difference in rate into actual hours paid. Why it is actual hours paid? Because for the entire hours paid, it was the responsibility of personnel department to get them at the right price. So that is labor rate variance. Next, coming to idle time variance. What is idle time? It's a difference between actual hours paid and actual hours worked. What do we multiply it with? We multiply it with standard rate. Why multiply it with standard rate? Because the difference in rate is already covered in labor rate variance. Now coming to labor efficiency variance. What are we comparing here? So what is the standard hours? What is the actual hours paid? Why is there a difference? Okay, and the multiplier is standard rate. Okay, now let's analyze efficiency variance further. Okay, so we have standard hours, we have actual hours worked, then we have the revised standard hours. So what is standard hours? It is standard hours in standard mix. Revised standard hours is actual hours in standard mix, and actual hours worked is actual hours in actual mix. Okay, when we are comparing standard hours with revised standard hours, okay, so the mix is the same, the only difference is in hours. So we call it the labor sub-efficiency variance. When we are comparing revised standard hours with actual hours worked, the actual hours is the same, but the difference is only in the mix. So we call it the labor mix or labor gang variance. Okay, so thumb rule: for labor cost and labor rate variances, we are using actual hours paid. For idle time variances, we are taking the difference between actual hours paid and actual hours worked. And for labor efficiency, labor sub-efficiency and gang variances, we are taking based on actual hours worked. Okay, let's discuss it another way using our magic box. Okay, we have the standard cost, we have the actual cost. Standard cost is standard rate into standard hours. Actual cost is actual rate into actual hours paid. First, what we are going to do, we are going to eliminate the rate portion. So we have the actual rate here, so we'll get the standard rate here. Okay, so here it was an actual hours paid, we are again bringing the actual hours paid only. Okay, so this is the difference in rate, so it's called the labor rate variance. Now we have the standard rate. Now let's revise it once more using our magic box. Okay, so first we have the standard cost, that is standard rate into standard hours. Then we have the actual cost, that is actual rate into actual hours worked. From this, first we'll eliminate the rate portion, that is we have the actual rate here, we bring the standard rate, so we get the difference in rate, and the multiplier is actual hours paid, because for the entire hours paid we want the difference in rate. So this is the labor rate variance. Then we have the actual hours paid here. With the standard rate, we want to eliminate the idle time. Okay, so we have actual hours paid here, we bring the actual hours worked here, again the multiplier is standard rate, because difference in rate is already covered. This we get the idle time variance. Okay, now we have the actual hours worked, we comparing it with the standard hours, we get the efficiency of the employees. This is the first level of analysis. Now going to sub-analysis of efficiency variance. We have the standard hours, we have the actual hours worked. So the difference between standard hours and actual hours worked, always the multiplier here is standard rate. So the difference between standard hours and actual hours worked is the efficiency variance. Let's bring revised standard hours. So standard hours is standard hours in standard mix. Revised standard hours is actual hours in standard mix, and actual hours worked is actual hours in actual mix. So when we are comparing standard hours with revised standard hours, so if you see, the mix is the same, only the hours have changed. So we call it the labor sub-efficiency variance. Again, we are comparing revised standard hours with actual hours worked. Here the hours is the same, only mix has changed. So we call it the mix or the labor gang variance. With this, we've finished today's session. Go home, solve 1 or 2 questions, revise it again, revise it with logics. Don't just by heart the formulas, develop the formulas by yourself, because in exams, no matter how the question comes, you would be in a position to crack it. Thank you so much for listening to me. You're going to rock your exams.